Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Shares of Laurentian Bank are surging today after the lender announced it is selling itself in two parts. Fairstone Bank will buy Laurentian for $1.9 billion or $40.50 a share in cash. Separately, National Bank will acquire all of Laurentian's retail and small business assets. Laurentian will exit retail banking to focus on commercial real estate lending, and Eric Provost will remain as CEO. Shares of Scotiabank are edging higher. The lender topped profit and revenue estimates in its latest quarter, with net income surging 31%. You can see it's up about 1.8%, 1.9%. The results were driven by better than expected performance in its capital markets and wealth management division. Scotia is 2 years into a strategic overhaul with its international division tracking ahead of plans. Earnings growth, though, at home has been slower. Shares of GoEasy are seeing some pressure. CEO Dan Rees is going to step down from the consumer lender effective at the end of the year. GoEasy says the move is due to a blood disorder that requires Rees to resign from his position. Patrick Enns, who is currently president, will become CEO January 1st. Rees will serve as special advisor to the CEO through June 30th. And taking a look at the markets, a little bit of caution right now, but the traders are waiting the banks to do their full reports, but a lot of the banks are showing some good numbers. Scotiabank, at least value-wise today, they're up, but Scotiabank released its earnings earlier today, beating estimates right now, though. The market itself down by about 0.4%. South of the border, some U.S. markets, some recovery, tech stocks and Bitcoin pushing the markets south of the border into positive territory. Everybody's in the green right now. S&P 500 up by 0.55. Dow Jones up by 0.6, and NASDAQ up by more than 1% right now. Laurentian Bank is selling itself in two parts, and Scotiabank has topped expectations. For a look at today's big stories in the financial sector, we are joined by Christine Dobby of Bloomberg News. Christine, thanks as always for joining us. Let's talk a little bit about the Laurentian deal. There's a little bit of this, a little bit of that, and some more of this and that.
Yes, a busy morning on the Canadian finance beat, as I think three of your headlines there were all about Canadian finance. The Laurentian deal, so Laurentian is selling itself in a few different parts, as you mentioned. Fairstone Bank has agreed to pay $1.9 billion to acquire Laurentian Bank, and it's going to refocus on the commercial lending operations. Fairstone Bank, for viewers, is an alternative mortgage lender that is majority controlled by the Canadian billionaire Stephen Smith. And so as part of this whole transaction, right before that closes, National Bank of Canada, which is another Quebec-based bank, is going to be assuming all of Laurentian Bank's retail and small business operations. And Laurentian Bank's branches in Quebec will all be closed eventually. So that's kind of the broad sweeps of the transaction that was announced this morning.
All right, and it's been a bit of a rocky road for Laurentian, hasn't it?
Yeah, about 2 years ago, the bank underwent a strategic review and ultimately did not find a buyer. And within about a month of that process wrapping up without it finding a buyer, the bank got hit by a really massive technology outage. A lot of services were interrupted. And that was quickly followed by the really sort of sudden exit of the CEO, Raina Llewellyn. And then Eric Provost stepped in at the time. But since that time, there's really been questions about the future of Laurentian Bank. And it's been selling off various parts for a few years now. And so I think this kind of finally answers the question about its fate, and it really does mark the exit of another small bank from the Canadian banking landscape, which is dominated by the big six banks.
And just want to get to, we're almost out of time, but Scotiabank beat earnings estimates today. What was behind the results?
Yes, speaking of one of the big six banks, the EPS beat here was largely driven by capital markets. But on the call, executives were talking about hoping for double-digit earnings growth in the Canadian banking division next year. So I think you're seeing a little bit of momentum in the shares, probably based around some of those comments today.
Okay, Christine, we'll leave it there. Thanks very much for joining us.
Yeah.
Christine Dobby of Bloomberg News. And just a couple of quick notes. Laurentian trading almost over 18%. Bank of Nova Scotia up by close to 2%. Well, Scotiabank topped adjusted profit estimates in its latest quarter. We're getting more bank earnings throughout the week, but let's turn to the markets and see how they're doing. We're joined by Ted Rakshafen, Portfolio Manager, President, and CEO of TriDelta Private Wealth. And Ted, thanks very much for joining us today.
Thank you.
You want to look south of the border right now, don't you? The concerns on the valuations down there.
Yeah, I mean, I really think that, one of the things we follow is something called the Shiller PE Index, and it's just a measure of valuation. It goes back with data back to 1880. It hit 40 this month. So 40, the higher the number, the more expensive it is. The last time and only time it hit 40 was in 1999. And 1999 was as the dot-com bubble was just starting to filter up to its peak.
And are we in the same situation? Does it feel like we're in the same situation? Because we hear people talking about AI, which is fueling a lot of it, and they're saying it's different this time. Is there a lot of similarities, or does it feel like it might be a little different?
Well, I always say history always repeats itself, but never in the exact same way. So I don't know. I don't know if it's the same. I know it'll be a little bit different. I mean, people point to sort of the biggest companies and that they're profitable and make real money, which is absolutely true. But there's always something that trips up companies that do exceptionally well and are very expensive, because they're expensive not because of how great they are today. They're expensive in part because the future expectations are huge.
Yeah.
And they don't always meet them.
And so what do you do? What are you doing in this situation then when you're looking at that, when you're seeing the Shiller and seeing the similarities to 1999? What are you doing?
Well, a couple of things. I mean, again, very quickly, from 2000 to 2002, the S&P 500 was down double digits 3 years in a row. $1 million would have dropped to $625,000. But at the same time, bonds were up 3 years in a row, double digits. $1 million invested January 2000 would have been worth $1.3 million at the end of 2002, so double what it would have been in the stock. So that gives us some pause. What do we do here? So we have a few investments we're looking at. Just traditional bonds, whether corporate class, which are more tax efficient, or broader corporate bonds, we're looking at that. There's an option strategy that basically is kind of isn't correlated to the market. It will return 4, 5, 6, 7% in general, very tax efficient. And the other one is we have a 2-year note that we put together with a company, pays 10.25% and pays interest every month. And again, it's not correlated with the stock market, so we really like that investment as well.
And what kind of a weighting are you doing with everything?
Well, that's the key question, right? Because even though we're concerned, timing is never perfect, right? We don't go from 60% stocks to zero, because who knows what next week or next month will be. But if a client should be in sort of a 50 to 70% stock weighting, we're trying to get stocks down to the 50 range as opposed to the 70 range. So we're trimming back a lot of sort of, I'll call it the overweight stock range to put into that.
And just want to go back to you mentioned option strategy. How are you working that? What are you doing with that?
So there's a couple of companies that have really good option strategies. One is a company called Purpose. They have a premium yield fund. And Dynamic has a couple of similar type of premium yield funds. Some of them are a little bit more correlated to the stock market. So when stocks are doing great, they do great. I tend to lean a little bit more to the Purpose premium yield because it's less tied to the stock market, and which is really what I'm trying to do. If I'm trying to remove risk from the stock market, I just don't want to put it right back into something that's tied to the stock market.
A little bit of protection for you.
Yes.
And what we're looking at, any indicators where we're heading and how long we might be heading with this? Because you're talking about those numbers that are similar to 99, could it take that long if it does go, we do see the drop that may come?
Well, again, these things are never certain. As one of the things that is interesting is last time we were at 40 PE and the Schiller PE index was January 1999. And 1999 was a great year for the stock market. So just because it's super expensive doesn't mean tomorrow it's going to drop.
Yeah.
But in answer to how long, we do see that, there could be 10, 20, 25% drops in stocks. And the question is, does it start today or does it start in 6 months? We don't know. Yeah. But what we want to do is we want to be a little bit cautious and a little bit hedgy, as they say today.
And with the Schiller number, were there times before that have come close to 40? And were there similar factors that was that one group that was driving everything? Yeah,
it's interesting because it never got that high. I mean, there were times where it was in the 30s, mid-30s, low 30s, but it never got higher than 40 except in that dot-com bubble in the late 90s. So, are we, again, apples to apples? Probably not, but is it apples to oranges? And are oranges still fruits? Yes, they are. So I think it's close enough that and part of our job really is to say, how do we look at caution and react to it and not ignore it? And that's kind of where we're at today.
Okay, we'll leave it on that note there. Thank you very much for joining us. And that was Ted, Ted, my computer is going wacky again here. Ted Rakshakin is portfolio manager, president, and CEO of Tri-Delta Private Wealth. We've had some interesting technical issues going on, but thank you very much for joining us today. It's just one of those days. We'll have more coming up. An investor perspective on Scotiabank's better than expected results. That's next. News coming out on Canadian banks today. Scotiabank posted better than expected results in its capital markets and wealth management divisions, and Laurentian Bank is being acquired by Fairstone and National Bank. For more, we were joined earlier by Lauren Steinberg, president at Lauren Steinberg Wealth Management.
I mean, Laurentian has never been able to compete with the other Canadian banks, never been able to get their technology act together, don't have the capital. This is a great deal for shareholders, and even though there will be layoffs, the Caisse de dépôt in Quebec is in favor of the deal. It'll be better for their customers as well as National Bank takes over the loan book and deposit book, and it's turning a chapter. No more Laurentian Bank branches in the province of Quebec.
The shareholders in Laurentian Bank get something. They get $40.50.
Absolutely. I think it's at least a fair deal for shareholders, and they can redeploy their capital elsewhere. And the deal looks like it makes a lot of sense for everybody.
But it looks, from my reading of it, it looks like Laurentian's branch employees and branches will all be gone. National Bank's just shutting all that down.
Exactly. They're simply buying the deposits and the loans, National Bank. Fairstone's going to buy the commercial operations, and it's a sad day for the employees.
Yeah, there's some vague assurance that they'll be eligible for jobs at National Bank. Yeah. Talk to us about Bank of Nova Scotia. It looks like they are delivering under their relatively new CEO. He's been there about, I think, 2 years.
Almost
now.
3 years.
Oh, 3 years.
Almost 3 years. Wow. In February.
Not that new. Yeah.
And he took over. They embarked on a strategic plan, de-emphasizing Latin America and redeploying capital, Andy, and really more domestically, U.S. wealth management and the like, coming off a rather brutally bad 10-year period for the stock. Mm-hmm. And for shareholders, let me say the strategic plan seems to be working. It's well underway. Significant improvement in wealth management, certainly in capital markets area. And ongoing, and international as well to some degree, but the Canadian operations still have some work to do.
Yeah, I'm just looking at broadly provisions for credit losses, about $1.1 billion, slightly above what Raymond James was watching for. I guess provisions for credit losses are going to be a hot topic this reporting season.
They are, and so far we're not seeing, don't expect to see any huge increase in the PCLs, I have to say. Canadians are still in decent shape, and interestingly enough, in the last quarter, so far, bankruptcies and on the consumer side and business side have actually been a tick lower a bit. But if this economy continues to moderate, for sure that'll be an issue.
Which banks do you own, Lauren? Can you give us some idea?
We own the big five, actually.
Okay.
The only one we don't own is National Bank.
Oh.
We own them in different weightings. National Bank we are most bullish on only because the valuation is such a wide valuation gap between everybody else.
Sorry, Lauren, National Bank you're less bullish on? Or?
National Bank we're just less, but sorry, Bank of Nova Scotia we are most bullish on.
Oh, I see, sorry.
Because of the valuation gap, lower price earnings ratio, lower price to book, but really this big improvement we expect Bank of Nova Scotia the next couple of years to outperform in terms of earnings per share growth the rest of the sector.
Maybe we could put up a 5-year chart for a Bank of Nova Scotia or even a 10-year chart, because I'm not clear actually whether they're back into record territory yet. Some of the banks, as you know, have been doing that. It looks as though they are near a record anyway.
Sure, but they've underperformed the rest of the sector in a significant way. Listen, I have to say it was a bit of a surprise. This new CEO came from outside of the banking sector. But maybe they needed a fresh pair of eyes to really focus this business, and I think they're doing a very fine job.
What is your feeling on the worry that AI is something of a circular bubble, that NVIDIA gets big contracts and then uses that money to invest in its customers?
Sure. So one thing, the positive side of AI, like AI is real. All of the Canadian banks are laying people off in large part because of AI. The issue is all of the so-called AI tech and communication companies, the NVIDIA, Alphabet, et cetera, they are plowing so much money into capital expenditures in the next couple of years, in the hundreds of billions of dollars. There's a question, will they get a return on all of that money? Or is this becoming a game where everybody's trying to outspend the other player? And one of the risks we see in the markets going forward, in 2026, if these companies' earnings deteriorate somewhat, there could be quite a long way to fall for some of those companies.
A couple of stocks on your radar here, Nestle and Unilever, global consumer products giants.
Sure, this is one of the many ignored sectors. And Nestle, if you're buying it, you're getting it close to a 10-year low. Again, new management, we're looking for earnings to rebound over the next few years, close to the double-digit level. Coffee's their biggest business. Pet food is their next biggest business. They distribute all Starbucks coffee, actually, that is not sold in a Starbucks. And so this is a company that is extremely cheap, biggest food company in the world, poised for some good earnings growth. Unilever, a little bit more advanced in their turnaround. They're experiencing better earnings growth. But again, both of these companies, a massive global footprint, somewhat ignored by investors with everybody flowing money into tech.
And so offering decent prospects, those two.
Decent prospects, also good dividends, healthy dividend growth going forward, and best in the business.
And he was speaking with Lauren Steinberg, president at Lauren Steinberg Wealth Management. Coming up, we'll get an update on some market movers with Bloomberg Equities reporter Monique Molima. All right, time to take a look at some of today's market movers, and we are joined now by Bloomberg Equities reporter Monique Molima. Monique, thanks as always for joining us. Let's get right into it. American Bitcoin, a little Trump connection there. It's struggling.
Yes, so American Bitcoin, they're a Bitcoin miner that was spun out of the Canadian company Hut 8. And Eric Trump is one of the co-founders of the company, and Donald Trump Jr. is a shareholder in the company. This is a Bitcoin miner that went public earlier this year, and its shares are down over 40% today, as there's been a big pullback in the crypto markets. We've seen Bitcoin prices decline about 30% from their high that they saw earlier this year, and that's really impacting Bitcoin miners. For American Bitcoin, that's the bulk of their business, is the ability to mine and sell Bitcoin. So if the prices are lower, then there's a lower amount of money that they can make off of that, which is what's really been impacting them. And some investors are, I guess, just starting to question kind of this model. A number of other Bitcoin miners have diversified into other areas like AI data centers that can kind of hedge a bit against the declines that they're seeing in Bitcoin. But for American Bitcoin, they're still moving a lot off of just the price of the tokens.
All right. And Albemarle getting some good news when it comes to lithium for the battery packs.
Yes, so Albemarle, they got upgraded today at Baird to neutral. They're seeing more opportunities for this company. Like you mentioned, they're in the lithium space. And for a while, a lot of the focus for lithium was the applications for electric vehicles. But those markets haven't really taken off as much as some people had initially hoped. But what analysts are now seeing is there are also other large applications for lithium. They're seeing opportunities in energy storage, which can help grid suppliers with like managing their flows of energy at different times. It can also help with affordability. And they see more opportunities for that for Albemarle going forward. They also note that the company has been focused on cost-cutting measures, and they see that being a continued catalyst for the stock if they can bring down those costs more and then see more opportunities for growth in these other areas.
Okay, and last but not least, some good news for Solaris Energy.
Yes, so Solaris Energy, they were initiated today at Morgan Stanley, and they got a really positive rating as Morgan Stanley sees a lot of opportunities for this company. They're in the data center power generation sector, and this is an area that's seen obviously a lot of growth with AI power centers needing a lot of energy. And the analysts say that they think there's going to be more needs for energy going forward. They expect the demand for power to kind of outstrip the supply in the next few years, and companies like Solaris to be able to capitalize on that and also to be able to deploy energy a lot faster compared to some of its peers, which they think is going to help them going forward. And they note that the share prices haven't fully priced in all of the potential growth for the company. So I think there's also more opportunities for the stock price to rise higher as people kind of look further ahead at the energy storage opportunities.
Okay, Monique, thank you for that. Bloomberg's Monique Malima. Coming up, we'll have more on that big deal in the banking sector to dismantle Laurentian Bank. Shares of Scotiabank are moving higher after the lender topped profit and revenue estimates in its most recent quarter. The results were driven by better than expected performance in its capital markets and wealth management divisions. Scotia also forecasts faster growth next year in its core Canadian banking division and now expects double-digit growth in profit. The global economy is forecast to grow this year in its upgraded outlook. The Organization for Economic Cooperation and Development says the world economy is expected to grow 3.2% this year, an improvement on the 2.9% it predicted back in June. The OECD is also raising its forecast for U.S. growth to 2%. The organization says, despite concerns about a sharper slowdown amid higher trade barriers and significant policy uncertainty, the global economy has shown resilience. Shares of MongoDB are seeing a surge, that after the database software company raised its full-year profit and revenue outlook as demand from AI continued to bolster revenue. The company's database platform also expanded 30% compared to the year before. Mongo says the results were also boosted by its growing customer base. And taking a look at the markets, you can see the TSX off as the traders await some banks to report. Of course, Scotiabank released its earnings today, beating estimates. U.S. markets, different stories. Some recovery there. Tech stocks and Bitcoin pushing the markets south of the border into positive territory. Well, actually, the S&P just dropped down below. It's at about a wash right now, but Dow and the NASDAQ still up slightly right now. Well, Laurentian Bank is up more than 17% after it announced a split sale to Fairstone and National Bank. For more on this, we're joined by BNN Bloomberg's Lindsay Biscay. Lindsay, a little bit of this weaving in and out and the final results. How's it all unfolding?
Yeah, I should mention, too, I just checked before I came in here, Laurentian Bank is now up more than 18%. So this is a big day for the bank, I guess. A lot of analysts are saying that this is a really big day for Laurentian shareholders. The bank just couldn't really compete with the other big banks in Canada. It had a lot of baggage over the years, just didn't have as much capital. So this really is the kind of perfect exit for Laurentian Bank. So when we're talking about this deal, Fairstone Bank is acquiring Laurentian for $1.9 billion in cash. And as part of the deal, the National Bank of Canada is buying the deposits and loans of Laurentian. However, branches and employees will not be transferred to the National Bank. So that does mean that we're probably looking at layoffs. All of the locations of Laurentian Bank, which are in Quebec, will close by the end of the year if this deal goes through. Apparently, Laurentian Bank employees will have kind of like first dibs at any openings that are in National Bank, but we'll have to wait and see if that actually comes to fruition. As I mentioned, deal is still subject to approval by Laurentian shareholders. They need 2/3 in favor of the deal for this to go through, but many analysts are saying, this is, again, is the best case scenario for Laurentian, and so it's expected that this kind of split sale will actually go through.
Yeah, and the offer is pretty good, 20%, right?
Yes,
Premium on it?
20% premium.
Yeah, so that's not too bad. Now, what are the analysts saying?
Yeah, so, well, as I mentioned, most are saying that this is a good day. When it comes to on Bloomberg, there's a couple of holds and underperforms still for Laurentian, but we see that stock price just skyrocketing today, so a good day for shareholders. We spoke, I know you spoke actually with Rob Russell this morning, co-founder of Hamilton ETFs. He says this is a small deal, and what he's really watching for is not what's going to happen with Laurentian Bank, but what's going to happen with the National Bank instead. And of course, National Bank actually has also hit an all-time high today. Last time I checked, it was at $169.77. But he says this is a great deal for National. Yeah, you can see it's up at 1.3% at the moment. National doesn't have to take on any of the baggage that Laurentian has been carrying around for a couple of years now.
A little bit of a rough stretch.
It's been a rough stretch, and really, so National Bank really just taking the best parts of Laurentian. And as for Laurentian, Wessel says this is a 20% premium to yesterday's close. It's as good as it's going to get for the bank, so just kind of take it and run. Here's more on what he had to say.
On Laurentian, this is kind of, I don't want to see the end of an era, but we now have the two small banks are gone, Canadian Western Bank and Laurentian. And Laurentian has been struggling for a very long period of time. Almost my entire career, 30-plus year career, Laurentian has struggled. They managed to sell off of a reasonable multiple. So I think Laurentian is not that big a deal. I think the market will probably focus much more on National Bank, which is obviously a very, very successful company. And I think at the margins, this is not a marginal transaction. For National Bank, this is actually a pretty good one. They acquire retail loans and deposits. They get some SME loans. They get some small, medium enterprises, what SME stands for, and some deposits. It looks like it's going to be accretive to about 2%. It's going to be accretive to ROE. So, this is essentially a book value transaction. And so, it just incrementally strengthens National Bank in Quebec, which is obviously their ballast or their moat, if you will.
And so we also heard from John Aiken from Jefferies also saying that this is a good deal for Laurentian, good deal for National Bank. And he also mentioned too, National Bank acquired Canadian Western Bank last year. So really that Canadian banking landscape is just getting smaller and smaller. Again, hard for Laurentian to compete. And John Aiken also noting that, National Bank not acquiring any of those kind of like legacy issues that are coming along with Laurentian.
Okay, Lindsay, thank you for that.
Thank you.
BNN Bloomberg's Lindsay Biscaya. Well, in the day's other big financial news, Bank of Nova Scotia topped estimates on better than expected results at its capital markets and wealth management divisions, even as it booked a restructuring charge to cut expenses. Let's hear more from Rob Wessel, Executive Chair and co-founder at Hamilton ETFs.
The restructuring charge, should put some at the margins downward pressure on forward expenses. But more importantly, credit was stable. Very, very importantly, performing provisions, which the market spends a lot of time on because it's very discretionary, or would appear very discretionary, were up modestly, but still much lower than where they've been in previous quarters. I think that's a pretty key takeaway because the market is very much focused on them staying low as a supporter of forward estimates. Canadian banking, which is always a focus for Scotia, was flat. I think it's probably fine. And, they had some margin expansion. They had some good capital markets and regulatory capital remains strong and they continue to buy back shares. So I think all in all, the market will be pretty happy with this quarter. And then in terms of guidance, that'll also be important. The analysts will flush that out on the call, but They're looking for quote unquote strong earnings growth. So, we'll see how that all plays out and how the analysts and how it impacts consensus.
Now, with Canada, the Canadian sector, do you see more layoffs there possibly to try and help boost it?
That's hard to say. It would seem to suggest the restructuring charge in and of itself would seem to suggest that there's layoffs coming, as well as for compensation. Canada is by definition the biggest part of the bank, so I haven't looked at the details. So I don't know if they broke it out by business line, but I think right now that's a key focus of the market, Canadian banking. And one of the things that the banks can control is expenses. So by definition, I think at minimum, the market will be very focused on can they keep those expenses, flat to down.
And right now, I'm just looking pre-market right now that's down about 1%. How do you think the market's going to react when the bell goes?
Well, we'll see. The call is pretty determinative, particularly as it relates to guidance. I'm a bit surprised. I guess the question is, will it underperform the group? I think it'll probably have on a relative basis, a good day. As we know, the banks are trading, and I know we're going to talk about this in the next segment, but the banks are trading at healthy multiples. So there's a lot of good news priced in. So even if this is good news, the question will be, is it good enough news?
And will it be good? Do you feel it's good enough news?
On a relative basis, I think that they'll make up some ground. It's very hard to do day-to-day trading. I think, the bigger question for Bank of Nova Scotia on a prospective basis is they trade at a large discount. One of the reasons they do is because their ROE is quite low, and the market obviously is concerned about Canadian banking, which is fine. So, how it does in the next 6 to 9 months, this is a grind, right? These are super tankers. These stocks do not move quickly, the operating profitability does not move quickly. And so, Bank of Nova Scotia is going to this is a long journey. They're going to have to every quarter get some incremental improvements and try to get their ROE up so that they can, get some relative multiple expansion. Because right now this bank trades at a very big discount.
And is this kind of an indicator for the other banks, or do we have to take them individually, do you think?
No, well, so that's a good question. I think, generally speaking, the beat was for reasons and drivers that affect everybody. There was nothing really terribly idiosyncratic about Scotia's results. For example, it wasn't like international banking was on fire and therefore there's no real read through to everybody else. But no, credit was stable to, performing allowances or performing provisions were low. Capital markets were strong. Margins were expansion. These are expanded. So these are all things that affect the banks together, maybe not to the same degree. It depends on the bank. But yeah, I think this is a positive read through. But again, expectations were high coming into the quarter. So it's going to be hard to sort all this stuff out.
And CEO Scott Thompson said this quarter was all of our business lines reported year-over-year earnings growth. They're 2 years into that strategic overhaul. Does it look like they're on track? We talked about, of course, the numbers being off in Canada, but does the bigger picture, does it look like he's on track?
Yeah, I think so. It's a big journey, though. They have a lot of room to make up. Their ROE is quite a bit lower than everybody else's, or not everybody else's. Their ROE is quite a bit lower than the average. And as I said, these are big companies. It's very hard to move them quickly. So this is like the ground game in football. You're just trying to move 2 yards at a time, 3 yards at a time, in order to try to make progress. Nothing happens fast.
Rob Wessel is executive chair and co-founder at Hamilton ETFs. Allied Properties REIT has cut its monthly distribution to unit holders. We'll get more on that after the break. Urban office space developer Allied Properties cut its monthly distribution by 60% as the company seeks to reduce its debt. For more, we were joined earlier by Lauren Kelmar of Desjardins.
The distribution cut certainly was a big step in the right direction. I think it was a prudent move by management and the board. Arguably a little bit later than it should have been, but nevertheless, I guess better late than never. But as we sit here and look at the story, we look at the broader office landscape and some of the Allied specific challenges in the, coming down the pipe, we still think at this point there's a little bit more risk to the downside than there is upside to the name right now.
You're just reading your report. You say it's not 100% clear whether the distribution cut is permanent, but did you get any clarity on that?
I think I'm going to run under the assumption that they were setting a distribution policy for, obviously December 25 and 26. What I had thought about when I read the press release initially was something a la First Capital, where they temporarily cut the distribution during COVID and then reinstated it at the full level. I don't believe that's the case. I haven't received clarification as of right now, but for the time being, we're operating under the assumption that the distribution cut is a permanent distribution cut.
What was the problem at Allied? Just persistent weakness in their office real estate market?
That was definitely a large portion of it. I think what the catalyst for management and the board to finally approve a distribution cut was the slower than anticipated rebound in occupancy. And this was something that when we looked at the broader office market, we thought would be a challenge for the REIT. And really for all office properties outside of the core Class A+. The way we sort of looked at the recovery in the office market is sort of a three-phase recovery. The first is being driven by RTO, the return to office, right? We've seen some of the banks come back. A couple other large users have announced they're coming back. But we expected the lion's share of that recovery to be concentrated in the cores, in the buildings that you typically see banks occupy, right? Those big glass skyscrapers connected to the path as it relates to Toronto. And we believe that a more fulsome recovery would require a rebound in Canada's economic outlook, in business sentiment, and office using employment. And we think we're still a ways out from that. And even as that does begin to recover, we think, there's still going to be a lot of Class A vacancy there. Like I think Class A vacancy in Toronto is still around 14 or 15%. So we need to see that get down to kind of, in our view at least, the high single digit level before we see demand cascade outside of the core, outside of these Class A properties, and into the type of assets that Allied owns.
Did they've been involved in some big real estate projects in Toronto. I'm thinking about the Well, that giant development there. Did they bite off more than they could chew?
Hindsight's always 20/20. I think if you knew COVID was coming, you'd probably say yes. But to their credit, they got that office property 98% leased. And they actually finished the leasing during COVID. What happened there was Shopify, which was their anchor tenant, I believe they had about 350,000 square feet of space, decided they were no longer going to have an office-centric model. And as a result, they put up that space for sublease. And it's been a challenge for Allied to find a replacement tenant, but they have, I think they've spoken to the fact that they have had a lot of interest there, and we expect some more updates as it relates to that space. I believe they have made some decent progress there in the last little bit.
Maybe we'll put up the unit price again, ap.un. Is there a particular level at which you would be inclined to go to a buy? Right now, as you know, it's just above $13.
Mm-hmm. I think, as I mentioned, we think there's still a few headwinds that present some downside risk to the stock price. I think if we get more clarity there, the big one is fundamentals. There's a couple other capital allocation, potentially negative catalysts that could come their way that we're a little bit concerned about. But I think if we get more clarity there, I'd certainly become more constructive on the stock. And the other way I've sort of looked at it is if you look at the stock on a yield basis, a distribution yield basis based on the revised distribution, at current levels, it's a sub 5.5% distribution yield. We think that's a little bit tight. Probably 6 to 7% is a little bit more appropriate as things stand today. And a 6% distribution yield implies about a $12 stock price. 7% is about $10.20. So we think, if we get down to that 10, 11% range, it certainly makes a lot more sense to start adding at that point. But for now, we think it still screens a little bit expensive. Mm-hmm. And the other way we also look at it is, as you probably know, on an implied cap rate basis. And, where it's trading right now, it's about a 6.8 cap. And just based on the transactions that we've seen in the market, and granted they've been limited, but there have been some, we believe that still screens a little bit expensive based on the geography and the type of product that Allied owns.
We've less than 30 seconds. The office market, has it more or less stabilized? Can you generalize, Lauren?
I would say it's certainly come off its bottom. It is in the process of stabilizing. As I sort of alluded to before, we think the initial phase of this recovery, the RTO, has definitely taken hold. But until we see a broader recovery in Canada's economic outlook, office usage, employment, things I spoke to earlier, we think that there's still going to be some challenges there for the broader Canadian office market.
And he was speaking with Lauren Kalmar, analyst at Desjardins. Well, Propel Holdings has just received regulatory approval that will help it expand into the U.S. We'll have more on that next from the CEO, Clive Kinross. Canadian fintech company Propel Holdings has just received regulatory approval that will help it expand into the U.S. Let's get more now from Clive Kinross, Chief Executive of Propel Holdings. Clive, thanks very much for joining us today.
Yeah, good morning, Roger. Delighted to be here with this great news.
Now, you're opening essentially a bank in Puerto Rico. Why go for a bank and why Puerto Rico?
Yeah, so first of all, let me just take a step back over here and remind everybody the basis for our business model in the first place. We provide access to credit to underserved and underbanked consumers. So for the most part, these are consumers who are overlooked by mainstream banks and credit unions. There's about 90 million consumers in Canada, the US and the UK, which are the markets that we serve. And for the most part, these consumers could go into a bank, could open a bank account and really get little else in terms of services. From our perspective, we are absolutely focused on these consumers. In today's K-shaped economy, we're seeing record numbers of applications from this cohort or this large segment of consumers across these geographies. And we want to put ourselves in a position to provide them best-in-class products and services, including additional products and services. In order to do that, Propel Bank represents the next step in that evolution. By having a banking license, we'll be able to do a few things for our consumers, obviously able to offer them best-in-class banking products and services over the longer term, like debit cards and credit cards and other products that we'll be able to do with the Propel Bank infrastructure. In addition to that, we're a company who've significantly grown access to credit for consumers through partnering with banks who have the same mission of being able to provide access to credit to these consumers.
Now, does this mean then
let me round out the point, Roger. It's an important one, but by establishing the bank partnership, we'll be able to offer more consumers in more jurisdictions and more markets access to our and our bank partners' best-in-class products.
Will you be maintaining your relationships with the other banks, and where will this bank focus? Will it be the U.S. or larger than that?
Absolutely, we'll be maintaining our focus with our other bank partners. As recently as a month ago, we partnered with Column Bank. We're the first fintech in North America focusing on underbanked consumers to partner with a nationally chartered bank like Column Bank that extends our partnership now to 5 originating banks across the U.S., which is industry leading. By having Propel Bank in Puerto Rico will allow us to provide services to more and more bank partners. So if anything, the infrastructure provides the ability to create even more of these bank partnerships. And the real winner at the end of the day will be underserved and underbanked consumers.
And how does this tie in with anything you're doing in Canada? Will there be any crossover, or will this essentially stay separate and strictly U.S.?
It's an international bank, and certainly being an international bank will provide us with the ability to expand our services into other jurisdictions, not only the U.S., which ultimately is where our regulator's based. So we'll certainly be able to expand services into other markets down the road. I don't expect that to be anything imminent, certainly as it relates to the UK or Canada. But once we integrate with additional services, we'll be able to offer those services, including treasury services, across other markets as well. So not only does it create huge revenue generating opportunities down the road, but certainly being a bank, there's opportunity for lots of cost savings as well, which not only is going to be good for our consumers, but ultimately good for our investor base as well.
And I just want to get your thoughts on Laurentian being sold to Fairstone. Would you call Fairstone a competitor for you? And your thoughts on that deal?
So, for the most part, the biggest markets that we operate is Canada. Is the US, followed by the UK, followed by Canada. There's been fairly significant regulatory changes in Canada over the last year or so, making it more and more challenging for underserved and underbanked consumers to get access to what I would call better products from their perspective. And a lot of them are being pushed out of, call it mainstream or near prime markets, to less desirable forms of credit. I think today's transaction, if anything, makes the competitive landscape that much smaller at a time where, if anything, consumers in Canada need access to more product into better markets. So I'm still digesting the news. The multiple, from our perspective, was certainly interesting as well, and probably points to the potential in what is currently a huge underserved market, which is the underserved consumer, where we are seeing record numbers of applications in this K-shaped economy. And I don't think that's discrete to Propel. Okay. I think the companies that are focused on our segment of the market are just seeing very, very strong demand at the moment.
All right, we're going to have to wrap it up there. Clive, thank you very much for joining us.
Thank you. Thanks for the time. Appreciate it.
Clive Kinross is Chief Executive Officer of Propel Holdings. And thanks for watching Morning Markets. We'll see you back here tomorrow.